Moin zusammen und herzlich willkommen zu einer neuen Ausgabe von Exit2Go. Today we have another special episode. You can hear it. It's another episode in English, and we have Taliesen from Hahnbeck in our podcast. Hahnbeck is an M&A boutique. That's how they call themselves, and they help to find the best possible deals for seller. Not only Amazon FBA sellers, but also other direct-to-consumer brands. And we are very happy to have you on our today's episode. Welcome, Taliesen.
Thanks, Dustin. Thanks very much for having me. Hi, Hannes.
Yeah. You're welcome. So we've talked with each other quickly before this podcast, and we think that Hahnbeck is probably not that known, especially in the German space, because you're even active more on the international side. But as you have said, you also had already some German clients. But would you introduce quickly Hahnbeck for us? What are you doing? How long you are even doing it for? And give us a quick overview.
Sure, yeah. So Hahnbeck is an M&A advisory firm specializing in the consumer sector. So consumer brands, e-commerce, and technology related to e-commerce as well. By M&A advisory, we mean what the Americans call investment banking, what the British sometimes call corporate finance. So we only work with a small number of clients at a time. Each process for us is very intensive, very high touch. And as you said, we do everything that we can strategically to help the client get the absolute best deal and to protect their interests. We work with clients with both buyers and sellers all across Europe, the UK and North America. Our head office is in London, UK. But like you mentioned, we do have German clients. We closed a deal recently for a German client in the fourth quarter of last year. And more than happy to help and to help the German seller community. Absolutely. About half of our deals are US and about half UK and Europe.
Okay, cool.
So many of our listeners, their goal is to exit their FBA business in the next years. So we thought it might be interesting to hear insights from you or from M&A. So maybe you can just give a brief insight what happened between 2021 and now, because we all know the rush 2021 of the FBA aggregators. How did it change a little bit? What's your opinion on that timing now?
Yeah, 2021 was driven by, particularly the end of 2020 and right through the kind of first half of 2021 was largely driven by fear of missing out, FOMO, as they say, amongst the investors into the e-commerce sector. And they pumped a lot of money into the space, funded the aggregators, with more than $15 billion worth of funding now. And they were advising their portfolio companies, the aggregators, to make acquisitions as quickly as possible. With COVID tailwinds, e-commerce is quite a diverse sector, and everyone's performance is different. But largely, 2020 was a fantastic year in e-commerce. The start of 2021 continued, and it just looked like this was going to be a race to acquire as many of these brands as possible. And so that had an impact on their decision making around deals, around the speed of their due diligence and everything, the speed at which they were raising money. And so that was just a big race. Then from the middle of 2021 onwards, the middle of 21 onwards, particularly late 21 into last year, 2022, things dramatically slowed down from an M&A perspective, as you mentioned. Trading conditions obviously got more difficult for online retail in general. And the buyers in this space are online retailers. They're large online retailers. They were very exposed to the kind of increased challenges of increasing Amazon fees. Thankfully, temporary increased shipping fees, but and simply slightly reduced consumer demand, and not the continual rapid growth in consumer demand that had happened in the previous couple of years. So all of that started to feed through to the growth that they were experiencing, turning around and actually showing some decline in top line and particularly in bottom line for a lot of their portfolio brands. That then obviously caused some caution amongst their investors, understandably. Combine that with what happened in the capital markets, the nervousness from the war in Ukraine and so on. In 2022 was not a good year in the capital markets, where these investors obviously invest and draw from their funds. Excuse me. So all of that combined meant that what was fear of missing out is now fear of, I guess you'd say, overpaying, fear of being overexposed to relatively higher risk assets. And now that's feeding through to acquisition criteria really narrowing and buyers becoming more cautious. Part of it was also just a maturation, like the buyers in this space are growing and maturing in their approach and changing. They're developing specialisms in particular niches, and the space is returning to a more kind of normalized environment in terms of the M&A approach that they're taking, and I guess the due diligence approaches that they're taking, the multiples they're paying, and so on. Mm-hmm. Yeah. So I guess the answer to the question is, 2021 was awesome from the seller's perspective. 2023 can still be good. There can still be competitive. We're still finding for really good brands, there is still competitiveness in the process if it's run well, and we're still getting good results for people. But it is, multiples are slightly down for the really good brands. And the biggest impact, I think, is that for some brands, there's very few buyers at all now. And so it's actually more difficult to sell. So that's quite a significant change.
Yeah.
I have a quick question, because we also in our podcast in general, we as an Amazon seller, we definitely have kind of an Amazon look, and when we talk about exits, we often mean aggregators. They are specialized in the Amazon game. Was there even kind of a what you have called a race in 2020 even outside Amazon? Like, have you also seen a lot of direct to consumer brands in the e-commerce space in general have been acquired more quickly and stuff like that, or is that just kind of a part which only happened in the Amazon space?
It was accelerated in the Amazon space because just simply the unique nature of what happened with Thrasher had announced their Series C funding at the same time as some absolutely stellar results, basically revealing what looked like an opportunity that had been overlooked by the whole investment sector, but for a long time. That Thrasher had uncovered this model that you could conduct a roll-up of small companies, whereas roll-ups are really usually conducted of much larger businesses. And so in the Amazon sector, that really motivated a lot of people to get on board, and hence the aggregator model. But the consumer sector in general, like direct to consumer brands and so on, M&A for those brands was also super hot during that process. It's just that they didn't have the same kind of entirely new fund model that we saw with the Amazon space.
And now you mentioned that multiples are going down. That's something that no one of our listener wants to hear. But can you speak in averages? Like, okay, what was kind of an average multiple for good brand in 2020 compared to an average multiple for a good brand in the year 2023? Like, can you give a roughly number?
I can try. There is a lot of variance between brands, and there's so much that goes into it. Bear in mind as well that because we're in the advisory end of the market, we're not brokers, so we don't have like a website with hundreds of listings and things. We only work with a few clients at a time, and they tend to be larger, so they're usually above $1 million in net profit. But let's say the smallest kind of clients that we have are around $500,000 in net profit. Up to very big, up to above 10 million in net profit annually. But if we talk about, say, someone that's doing $500,000 in net profit, that has a really good brand, solid growth, and particularly growth levers for the future. Like it looks like the business should continue to grow for tangible reasons. It has some defensibility. Since we're focused on Amazon, we'll say it's an Amazon-focused brand. Maybe 90% of sales are on Amazon, 95% of sales are on Amazon. Maybe it does have a direct-to-consumer channel of maybe 5% of sales, but it looks like that could potentially grow. Good ratings and reviews on Amazon, and some defensibility, like I mentioned, with regards to it's not just the ratings that are protecting it on Amazon, but it's the something about the product that's fundamentally superior, and there's a reason to believe that people prefer the brand for some reason. It might be fairly early in its trajectory, but there's a reason to believe that will continue because there's something great about the brand, there's something great about the products. So in that situation, there would be, with a well-executed process, there should be a lot of interest in the business. And in the first part of 2021, a business of that level, we would be expecting to get it. Deal multiples, I think, first of all, just talking about deal multiples, it's important to describe what we're talking about. We always talk about the upfront consideration, not the earnouts and stuff, the performance-based. So this is talking about upfront, and this excludes inventory. So the inventory is on top. So we would be hoping to get in early 2021 a 6x multiple for business like that.
Based on STE? On the STE.
Yeah, good point. Yeah, 6x multiple of STE. I think most businesses around that time were trading, still strong multiples, closer to 5. But we would be aiming somewhere around that level, 5 to 6, like most great businesses. Now, a really great business like that, with $500,000 net profit, it's probably going to sell for around 4 or less, 3.5 probably upfront. Yeah.
Okay. It was also our expectation that we are currently around that multiple at the market. As you mentioned, the segment of Amazon, do you think, does it benefit if you have sales outside Amazon, for example, with D2C or Shopify? Does it increase the multiple, or does the buyer say, no, it's too much effort to maintain the Shopify store? Because we also heard that an external Shopify store is often not seen as a benefit.
Generally speaking, most of the buyers in this space, so besides aggregators, there's obviously strategics and PE firms. As the businesses get larger, that those buyers are interested, and we work a lot with them. But around the, say, 500K SDE mark, it's more likely to be an aggregator that's interested in buying it. Now, those guys are Amazon specialists. They do vary quite a lot. Each one is different. Some of them do insist on like 90% plus Amazon. Some of them are quite open to, only 50% Amazon, for example. But all of them intend for the business to be multi-channel eventually. So they want to buy brands, not just something that can only sell on Amazon. Now, having a direct-to-consumer channel, even if it's only like 5%, but starting to grow, that's profitable, it actually shows that it's not just an Amazon brand, so to speak, because there can be some doubt sometimes whether an Amazon brand, in inverted commas, in quotation marks, would translate into a direct-to-consumer channel or into potentially in a brick-and-mortar retail channel. So if you have a small percentage of sales, it's usually seen as a positive. If you have, I don't know, 10% of sales through eBay, 20% on Walmart.com, and 10% on your direct-to-consumer channel, you're drop shipping you're providing the products for Wayfair to drop ship for another 10%. That gets messy, and that is much more difficult to manage. But just to answer your question about direct-to-consumer, it's usually seen as a positive.
Okay.
And this can also affect the multiple at the end.
Bear in mind, pure direct-to-consumer brands are more valuable than pure Amazon brands, so to speak. Once you have, because you own the customer relationship, obviously. That's starting to change a little bit with Amazon, but still, by and large, they're Amazon's customers. Whereas if you own the customer relationship, it's more valuable. Obviously, the most difficult part there is acquisition, cracking then the puzzle of customer acquisition is the hardest one.
Yeah.
So the best part would be if we say, okay, we have 5% Shopify, and this works, like this business model works, and we show that there's a growth for the buyer, but we don't make use of it at the moment. So this would be the best case, right? So to show there's possible growth, but we don't have the capacity to make use of it there. Yeah.
Exactly.
Okay.
Okay. Now you have mentioned for a good solid brand you would get 3.5 for the multiple. Now the question is what is a good and solid brand? So the overall question, what is the aggregator for now looking on? Is there do we have like specific KPIs which are aggregators or maybe even strategic buyer paying closer attention to? Are there any specific numbers in general which everyone seller should take care of?
Yeah, absolutely. And those models, I would say, are for great brands. I guess what everyone's aiming to do, what everyone's trying to build, is not just a kind of good brand from a M&A perspective, but a great one that's going to be really sought after. That's the kind of multiple. And even then, it's going to take some negotiation, but we've got one like that at the moment, and yeah, that's the right range. Now, what are buyers looking for at that level? Margins. These are not in any order, but margins is one where we can put a number on it. They should be above 20% net margins.
Mm-hmm.
And if it's above 25%, it's actually more attractive. If it's above 30%, it's even more attractive. It's really hard to have a business that's growing and maintaining net margins above 30%. But if you do, it just insulates the buyer from so much extra risk. It's a much more attractive proposition. It gives them a lot of leeway to increase their spending on marketing and that kind of stuff. So anyway, margins, but there is a minimum. Most buyers will consider 15% net margins, but it's going to be considerably less attractive. And some of them will rule out everything below 20%. Some of them have a specific line at 18%, they say. But broadly speaking, you should aim for above 20%. Differentiation, like I mentioned kind of briefly before, the products and your brand needs to be defensible, not just because of the ratings and the reviews that you have on Amazon. So it shouldn't look exactly the same as hundreds of different competitors. Mm-hmm. So there's lots of different ways of differentiating. We had a client once that had a very good, very complicated supply chain, but it really protected him from competition. So instead of buying the product from one or two suppliers, he would buy components from different suppliers in China and have I think it was about 4 different suppliers in China, and have a 5th one, assemble them all into his product. That complex supply chain is super hard to copy. So that's just one example, but there's lots of different, you can have another very difficult one is actually getting, design and utility patents. That obviously adds additional protection, but it's expensive and time consuming to go down that road. Getting exclusive kind of rights to sell a product that you may not have the patent to yourself, but if you've got the exclusive rights, that gives you differentiation. Or developing a product on your own and getting those rights yourself obviously gives you differentiation. Yeah.
So it's just important, don't have kind of a Me Too product where you can find exactly the same product on Amazon, because it's always hard to find a way to differentiate yourself to be not only different but to be even better, and then still have a reasonable selling price. I mean, it's a kind of a struggle probably every private label seller has to go through. But yeah, I think it's a good point, and I even have this feeling like a lot of sellers are now really focusing that part. I mean, when I look into our brands, like we always now try to never have kind of the product where we can say, okay, this is exactly the same product already on Amazon. And I would like to know if it's already a great differentiator for you, if you start to create kind of like unique bundles. For example, okay, there's nothing special about the product, but there are like components. I mean, you mentioned the complicated infrastructure from one seller, but would it even be beneficial where you can say, okay, you can buy this product kind of on Amazon, but not as this kind of set, and no one is selling this set. Is this already a kind of a differentiator for you, or would you say, okay, it's actually pretty easy to copy something like that?
It is if consumers agree, and they so that they start to, they give you better ratings. It shows that you're having higher sales velocity. Customers want the product more. They start searching for your brand. If what you're doing is working and consumers are seeing a difference, then that's one major piece of the puzzle. The other point, to directly answer your question, is whether or not someone else can do the same thing, copy you, and easily kind of replicate it. That's the other part. That's the other piece of the puzzle, and it's kind of a case-by-case basis when you look at that. In that situation, it often is if you have a real lead in ratings and reviews on Amazon, at that point, that's where they become really valuable. If someone potentially, theoretically, could copy you, but no one has really done so yet, and you have such a huge lead on ratings and reviews that, and compared to all the other competitors, you do have a distinct advantage. Theoretically, someone could come and copy you, but they'd be starting from scratch. It'd be super expensive for them to catch up to you. At that point, it is the ratings and reviews are a real moat. The question, and it does add a lot of value. It still draws some questions around how transferable it is to another channel and so on, but where you don't have the Amazon ratings and reviews lead. But to answer your question, it does add value.
I have one topic, because many of our listeners have big respect for the due diligence. So they don't know, have I done anything wrong, or is everything right with my data room or with my data or financials? From your experience, what are typical bottlenecks in terms of due diligence, which can also cause a decline of the multiple? Are there any classic mistakes from sellers, FBA sellers, which happen like every due diligence, and which could we prevent in front?
There's so many. In fact, people don't talk enough about due diligence. There's a lot of discussion around offers and getting the best offer and stuff. Offers don't even really matter. It's what happens in due diligence and closing the deal that matters. And the multiple, the price that you're getting, and also the terms of the deal, how much risk you have to take on, that's what really matters. And so the due diligence, people should talk a lot more about that whole process. When you get into due diligence, you asked about things that can kind of derail the process. First of all, it's important from the seller's perspective. There's a saying in M&A: time kills deals. Speed helps. So anything that can slow down the process introduces an increased risk that something random will happen that will derail the deal. Someone, I don't know, Amazon will take down one of your listings or something random that you can't predict. The longer the deal goes on, the more likely something like that is to happen. So speed is important. Preparation is important. Having all of your ducks in a row. If you have a recent topic is, for example, the UPC barcodes. If you've been buying them from resellers, then quite often the buyer in due diligence, if they discover that, will see it as a huge problem, and it's kind of too late to fix it, or very expensive to fix it. So identifying that early and doing something about it before going to market is a much better plan. Same with any compliance issue, any legal issue. Not every legal issue, not every historical legal issue, can be perfectly clean or perfectly dealt with, but it needs to be thought through and explained, and the logical measures taken, whatever they are, to show that this risk is minimal, rather than kind of not even thinking about it, and then not even introducing it to the buyer in the right way. They discover it themselves, and then it seems like a huge problem. Those kinds of things can derail deals. Accounting stuff. Accounting is a huge area in itself, but calculation of profit margins both ways. If there are errors in calculation of your COGS, for example, that's a classic one, excuse me, and your margins are substantially less, then that can derail the deal and cause the buyer to retrade on it. Even if they're a little bit less, the buyer will opportunistically sometimes try to retrade on the deal. So we help our clients to prevent that by making everything super clear up front before going into due diligence, getting assurances from the buyer beforehand and so on. Other things, particularly thinking about P&L, a topic recently for us has been Amazon Global Logistics, people that have been using AGL for part of their shipping. In the last 12 months, almost every client that we've seen has been accidentally double counting the cost of AGL in their accounts. And it makes their profit artificially look lower than it really is. So just the software picks up the Amazon expense, but they forget that it's also built into their COGS.
Okay.
That's a really
good point.
Yeah,
it's a good point.
Yeah, there's just hundreds of things like that. That one wouldn't derail a deal, but that would leave value on the table that the seller misses and the buyer gets. That we spend most of our time thinking about what the buyer is going to be like in due diligence and protecting our clients strategically through the due diligence process, which usually starts way before that. It even comes down to thinking about the buyer, like which buyer to choose. If you're lucky enough to have a competitive process is well run, you'll have several buyers and you'll be able to kind of weigh them up and choose. In fact, even if there's only one, you can get some assurances from them before going into due diligence. After you've signed an LOI, all the power shifts to the buyer. You're in exclusivity then. And theoretically, you can, after due diligence finishes, you choose not to proceed with the deal, you can go back to market. But your power, when you go back to market, you have less power. So the buyer knows that. The buyer has a lot more power in due diligence. So before you go into due diligence, understanding things like the buyer's relationship with their investors, how that works, who is calling the shots on, like, how does the relationship actually work? Some buyers, for example, have a lot of leeway to make all the decisions as long as it doesn't go above a certain multiple. Others have to check every minor detail of every point with their investment committees. And so the investment committee potentially could they're a bit more of a risk. They could veto a deal for relatively minor issues. Some of them have what's called subordination agreements that mean that the debt that the lender who's provided the funding has the right to effectively veto any deferred payments, like your earnout effectively, even if you've met all of the other hurdles, the commercial hurdles. If there's a subordination agreement in place, the lender could still veto it, and you wouldn't theoretically might not get paid. They'd prefer not to do that, but the fact that in some cases that exists is a risk. All of that kind of stuff you have to weigh up before you get into due diligence rather than after.
I mean, it's very, very interesting to hear that, because I really think that when people start thinking to sell a company, most of the thing that matters to them is, okay, where can I get just the best price? And just like thinking about stuff like that, who is the buyer and what can slow down the process, what can maybe even affect the price during the due diligence, I think it's brain work that a lot of people are not doing. I mean, honestly, when I think about our first sale of our first brand, we just went after the price. And I mean, I even think we have been a little bit lucky, to be honest, because at the end, what was very interesting to see for us, we got the exact same offer which we have gotten in the letter of intent. And I think that's not that common, right? I mean, a lot of times aggregator will try always to find a reason to say, look, I think we have to discount something here, right?
Yeah, that's right. And to be fair to them, sometimes it's warranted. Like sometimes there's something that was misrepresented in the early stage. But strategically for them, you're right. It's in their advantage to have everything relatively vague before LOI, then go into it in real detail during due diligence, discover something at that point that makes the business theoretically less profitable or worthless, and then use that to argue for a lower price.
So you probably have kind of a maybe even internal list, and you have some information about aggregators probably that other sellers just don't have. I guess, right? When people come to you and you got two offers and maybe the numbers are the same, they are probably never the same for you because you can even evaluate the company itself, I think. I mean,
Yeah, and it's also you can just ask good questions like what's their LOI to close rate, for example, of the number of LOIs they've signed, how many have closed, and you get a sense of the way they answer the question and the number itself. It gives you a sense of like their approach. Are they just signing a lot of LOIs and only closing a few of them, or do they really do a lot of work beforehand and they pretty much use due diligence as just a verification process? And it's the latter is what you want. So yeah, obviously we've got market knowledge, so we know a lot of these guys, and we understand for many of them their relationships with their lenders and all that kind of stuff. But even for someone who's potentially not using an advisor like us, they can still learn a fair bit by asking the right questions.
Mm-hmm.
Is it also a part of your advisory to calculate, for example, the SDE or the COGS? Because I think many sellers don't know how or which line items I can adjust from the SDE or what should be deducted and added. Is it also part of your? Is it?
Yeah, absolutely. Yeah, that's absolutely core for us. Add backs. I think all brokers even will be able to help you with add backs. We've got chartered accountants on staff, and we basically fully optimize the accounts, not just add backs, but we make sure everything is according to general accounting principles. Because occasionally we're up against. Well, I shouldn't say up against. It should be collaborative. The process should be collaborative. But in due diligence, the other side, the buyer side, this is an aggregator, was represented by PwC in
the audits.
But the auditor for the financial due diligence. So it was important that everything was, on point. It had to be correct. Actually, our head of finance actually spotted an error that they made, which was pretty cool, and saved our client a couple $100,000 in terms of working capital. But if he hadn't been on point and everything hadn't been all lined up, wouldn't have spotted that. So getting all of your ducks in a row with the accounting. Like another classic one, for example, just a basic one. A lot of the accounting software tools, like Sellerboard, for example, they will consider VAT, European VAT, as part of expenses. When actually technically under accounting it should be part of revenue. Now at the bottom the profit will still look the same, so theoretically it doesn't matter, right? But if it's shown as part of revenue, then if it's shown as part of expenses rather than revenue, then it makes the revenue actually look larger than it is, which
the
also
margin,
means
the margin looks higher if you have the net revenue instead of the gross revenue. Yeah. But that's
So
really a
just
mistake or an assumption which seller have that they.
Yeah, I mean, a lot of sellers are just using whatever's coming from Seller Legend or Sellerboard or wherever, and going to and not adjusting things like that. You have to get it right.
Yeah, that's interesting because internally we always calculate with net revenue because gross revenue is just it's a number, but we can nothing do with it.
Yeah, that's right. But theoretically, you could see the net profit at the bottom is the same. So it shouldn't, until you realize it actually affects your margin. Yeah, things like that.
Okay. So what can a seller actually do when they see an aggregator starts to negotiate during the due diligence and finds way to discount or decrease the price? Are there ways that a seller can protect themselves?
Honestly, most of the protection happens before due diligence. It's how well they're prepared. If they get into due diligence and there are legitimately errors with their calculation of their COGS, for example, and ultimately the profit is lower than what they thought it was, it's much more difficult to get the buyer to continue to proceed at the same price. All you have at that point are what's called in negotiation your BATNA, your best alternative to a negotiated agreement. You can just whatever they offer, you can just say no, you can pull out of the deal and you go back to your next best option, which might be another buyer who you've kept warm, or go back to market altogether. But that is kind of the nuclear option. You can use the principle of like a deal's a deal. You know, if it's a relatively small difference, you can see if you can get them to just overlook it in the principle of goodwill and just signing the deal at the offer price for reputational reasons. But from the buyer's perspective, you know, considering the situation they're in, that they have more pressure from their investors they have to deliver on. They're under pressure to not just make acquisitions anymore, but to run a profitable business. Asking them to pay the same price when the profit is less is tricky. So it can't. Ultimately, these things often end up being a discussion where you meet in the middle. Like you may, at best, get them to reduce by not the full difference. You know what I mean? That's if you don't have any other preparations in place and you haven't got any assurances from before due diligence that they're already happy with their accounts, which is what we ask for. If you don't have that in place before due diligence, you find yourself in that situation in due diligence, pretty much that's the best you can hope for to kind of not get a deduction of the full amount.
Yeah, I think that's a very interesting stage from the Amazon FBA seller, someone who is calculating prices for months and then get like, they have to take a decision like maybe in minutes and seconds to agree on. I mean, and this is huge numbers we are then talking about, right? I mean, it's not like.
Well, that's another thing. You shouldn't feel under pressure in that, but like you can always say, even if you're on a call and they bring this up, you can always say, let me think about it and get back to you.
Yeah, I think that's something a lot of people maybe should just like notice. Like you never have to make a decision right now, and that's something actually we even had on our first brand. Like they made offer, and we said, okay, let's think about it. They even said once, let's think about it. So don't try to make it happen in a call, right?
That's right. Yeah. Even if you're already ready to say yes. Sometimes it's better just to make sure and then say yes afterwards.
Yeah.
Don't show the happy face even if they're coming a high number.
Yeah. Sometimes, ultimately, that's another reason for having an advisor as well. Some of these conversations you don't actually have to be on, so you can have an intermediary who's completely impartial. Well, not impartial because they're representing you.
Yeah.
But the emotion is taken out of it. If they can be your go-between. It also enables the buyer to be a bit more frank, and you can sometimes get more out of the buyer because they can just say things to us that they don't want to say directly to you. Something that might come across as like, you know, whatever the reason is that whatever the dispute is, they don't have to be super complimentary. They can just tell us what it is. We can get to whatever the problem is quickly. They can also disclose to us like what the pressure is from their side, whether it's something from their investors or something, in just a very frank way. And it takes all of the emotion out of it, and the seller is not on the call. The seller doesn't feel under any pressure to respond, so that can be helpful.
Cool. Okay.
One question to the outlook. What do you think how the whole market or the whole M&A game or environment will change in the next years? Because we all know buyers and aggregators are dependent from the interest rates, or they have an effect of them. What do you think? What is your outlook for this year, next year? How the M&A game will develop?
I think ultimately the aggregator model works. You know, I think that for some people the jury's still out about that, but ultimately it works. These companies will have an advantage over smaller sellers, and therefore they will continue to be able to raise funding. Still in the short term, I think we're recording this in February 2023. I think before the end of March, or certainly before the end of April, we'll see some more consolidation amongst the aggregators. Not all of them are going to survive, but with so many of them, that's pretty much natural. You know, I don't think that's necessarily going to be an overly negative sign, but it's just natural that there'll be fewer of them, but their model will continue to be successful. I think multiples I don't think they'll fall any further. They're pretty much stable now. And in terms of interest rates, you know, that's an economics question. I think it's broadly speaking, people expect interest rates to continue to rise slowly over the course of the year before, you know, stabilizing and then potentially towards the end of the year or next year starting to come down. There's not really, I think it's shocks, interest rate shocks that are bigger concerns to capital markets than like predictable slow interest rate rises or falls. And I don't think, well, touch wood, I don't think we're in for any sudden shocks in terms of interest rates on the horizon.
Yeah.
Hopefully no more
Surprises.
Yeah.
I mean, that's not too bad. That's actually good news at the end, I would think. If a seller would come to you now and he would say, "Look, I'm planning to sell my brand within the next 2 years, maybe," what would be your advice? What can a seller do now to get the most out of it in 2 years?
Wow, that's a big question. Most importantly, build a great brand. I mean, this sounds like I'm asking them to do magic, to perform some kind of magic trick, because it's so hard. I appreciate how difficult it is to run a really great business. But if you can, build a really great brand, which also maintains good profit margins, that's the magical combination that makes your business really attractive and people want to buy it. If it's growing, has good profit margins, and has a really great brand that consumers seem to really love, that's the combination.
Okay.
Yeah.
Not easy though.
Yeah, that's of course the secret. Yeah.
I mean, we started to track to see how many people are searching for our brand, so this is an important KPI now for us. But
yeah, because we also understood that the brand has more value than just a cash flow brand or similar. So
That's right.
yeah.
All right.
Okay.
Perfect. Taliesen, how can someone reach you guys when they're in the process and they're thinking about to sell their brand, their company? What's the best way to contact you guys?
Sure. Our website is hahnbeck.com, hahnbeck.com. They can reach out through the website or just email us, the whole team. You can reach at info@hahnbeck.com. That's the best way to reach out.
Perfect. We will link both up in the description, so if anyone is interested, they know now where they can find you. And I really appreciate the talk. It's always interesting to hear from M&A boutiques and also from aggregators where the market is moving. And yes, thanks for this episode.
Thank you.
Yeah, thanks for having me on. I love what you guys are doing. It's cool how you're documenting your process. It's awesome.
Thank you.
Thanks. See you next time. Bye-bye.
Thanks, guys. Take care. Bye-bye.